When a small Texas-based company becomes critical infrastructure for AI giants like Microsoft and Amazon, is this just the beginning of a massive growth story, or is the stock already run too far too fast? And with management now targeting over $1 billion in operating income within just a few years, what are the chances of it actually pulling it off? Well, today, breaking down Applied Digital, what the company really does, why investors are excited about a potential third hyperscaler deal, and the catalysts that could push the stock very much higher, and the real risks that could derail the entire thesis. By the end of this video, you're going to have a clear picture of whether Applied Digital belongs in your watch list right now, or if the risk is just. I thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to Fool.to, get your 10 stock picks right now. Okay, so let's start with the basics. Apply. Digital is headquartered in Texas today. The company operates data centers specifically designed for AI workloads, and then it leases that computing capacity to large tech companies under long-term contracts. So basically, when big tech companies like Microsoft or Amazon need to train AI models, they're going to require massive amounts of computing power, docking and to do and talking about. Thousands of processors running all at the same time, which of course consumes enormous amounts of electricity. Applied Digital has stepped in by renting out that computing power because electricity is such a critical cost factor. Applied Digital builds its data centers in locations like North Dakota where power costs are actually no lower than the national average, and this strategy allows the company to offer competitive pricing while still maintaining solid margins, of course, on its lease agreements. So with that foundation set, let's move into what's been happening recently with the company. Now Apply. Digital recently announces plans to spin out its cloud business and merge it with Exo to form a new entity called Chronoscale. And why does this matter? Well, right now, Applied Digital operates 2 very different businesses, all under one roof. One business focuses on building data center campuses and leasing them to hyperscalers, and the other provides cloud computing services. And these businesses have very different operating models and economics. By separating them, Applied Digital can focus purely on hyperscale data center infrastructure. And that makes the business simpler, cleaner, and easier for investors to understand and value. And I think this move makes a ton of sense strategically, and it could meaningfully impact how investors view Applied Digital going forward. Because the growth trajectory here, it becomes much clearer. Now let's move on to the numbers, because this is where things really start to stand out. In the most recent quarter, revenue surged 250% to $126.6 million. And this was driven by new data centers coming online and the ramp-up of long-term lease agreements. Gross profit increased 93% to $26 million, and gross margin declined by 17 percentage points to 20.5% compared to the same period last year. So why did it happen? Why did margins compress? Well, here's what happened. The newer facilities are still in the ramp-up phase. They're not fully utilized yet, and this means the company is absorbing operating costs before these assets reach their full revenue potential. This is actually normal now. Margins will improve. As facilities mature and stabilize and fill up, operating loss widened 142% to $31 million as Applied Digital. Digital continues investing aggressively in growth at the same time. Net loss, well, it improved 89% to $14.4 million, largely due to favorable changes in interest expenses, and the balance sheet also looks pretty solid for a company at this stage, and cash equivalents reached $1.9 billion, providing significant firepower to fund future expansions. Total assets stand at $5.2 billion versus liabilities of $3.2 billion. Still very healthy. And here's the kicker: management just raised their guidance. They now expect operating income to exceed $1 billion within the next 5 years. Previously, the goal was simply reaching $1 billion over that same timeline. Now they expect to go beyond it. And that's something that investors should be paying attention to. So what could actually push Applied Digital stock up from here? There's several developments that could actually do this. And to me, the most immediate catalyst is the potential third deal. Management has confirmed that negotiations are underway with another investment-grade customer. Landing a third contract could add between $5 and $10 billion to the company's backlog, depending on scale. Would also reinforce Applied Digital's credibility as a provider that's capable of supporting multiple customers all at the same time. If we assume a deal, similar to, let's say, existing agreements and use a $7 billion contract spread over 15 years, well, that could translate to roughly $500 million in annual revenue once fully deployed. And with their net operating margins in the 60 to 70% range, this single contract could eventually contribute as much as $325 million in annual NOI. That is a meaningful portion of the company's billion-dollar target. Another growth driver is Polaris Forge 2, which is expected to come online starting this year in 2026. Remember, it's a 200-megawatt campus that's backed by a $5 billion long-term lease. Some revenue should begin flowing in during the second half of the year. Also, Core Reef could continue to expand operations at the existing Forge 1 facility as AI demand continues to grow, and this expansion could generate as much as $100 million in annual revenue. Current margins of about 20.5% that would contribute as much as $20 million in gross profit. Now, these catalysts are very powerful, but of course they do come with real risks. Now let's talk about what could go wrong. And the first major risk is power grid capacity in North. Applied Digital is attempting to deliver up to 600 megawatts of capacity across 2 major campuses and the local electrical grid. Well, it was never originally designed to handle that kind of demand. At this scale, any delays in grid upgrades could push revenue recognition back 6 or even 12 months. That matters because Applied Digital has committed timelines to their customers. Missing delivery deadlines could allow customers to reduce or even renegotiate their commitments. Another major risk is a potential slowdown in Applied Digital's entire investment thesis depends on continuing to increase spending on AI infrastructure. If one of these major cloud providers pause or slow down data center expansion this year or next, demand could weaken very quickly. And because the company already has high costs and quite a lot of debt, it doesn't have a lot of flexibility. If that demand softens, in a worst-case scenario, this could even become an existential risk. So with those risks in mind, let's have a look at the stock itself. Applied Digital currently trades around $37 a share. The stock's performance has been remarkable. Over the last 6 months, shares have been up roughly 272%. Over the last year, the stock has gained about 316%. And over the last 3 years, returns have exceeded well. 1,400% valuation, though, is where things start to get a little bit more complicated. Applied Digital trades at a price-to-book ratio of about 7. That means that investors are paying about $7 for every $1 of net asset value on the company's balance sheet. The price-to-sales ratio sits at 68, meaning investors are paying roughly $68 for every dollar of revenue the company generates. But is that actually expensive? Well, absolutely by traditional standards. But for an early-stage growth company that's already got committed leases and is still scaling infrastructure, these valuations can be justified. But execution has to match expectations over the next, several years. So that brings me to a final question. Is Applied Digital stock buy today? Well, consider that a consensus among 12 analysts. They rate the stock an average strong buy with an average score of 4.7, 5 out of 5. That's near perfect, and that rating has ticked slightly higher over the last 3 months. The high target price is $99 a share, and that suggests there's as much as 165% upside from current levels. So what needs to happen for the stock to get there? Well, Applied Digital is probably going to absolutely need to announce that third deal that adds to me at least $10 billion to the backlog. Forge 2 would need to begin generating revenue this year, maybe by late 2026 at worst, but without further delays, gross margins would also need to show some clear improvement. Management would also need to deliver on its new guidance by surpassing $1 billion in NOI over the next few years, which likely means hitting 1.2 to 1.5 billion. And just as importantly, are going to need to maintain or increase their annual capex on AI infrastructure.